Bonds and investment in bonds. So in this introduction to bonds, we will see what are bonds, how is bond valuation done. So first we'll see the significance of bond. A lot of money is required for investment in new machinery and plant in the industrial sector. For this purpose, they usually raise cash from investors, even though sometimes their savings are used. Considering the fact that they raise cash from investors, they primarily do it through two means. It is by raising debt or equity. Now, raising equity is owner's money and debt is borrower's money. So, for raising debt, it may be done for short term, usually from a bank, or for long term, the companies issue what is called as bonds or long term loans. So for long term it is bonds and for short term it is borrowings from a bank. So normally when companies issue bonds, they promise to pay or make a series of fixed interest payments, and towards the end of the bond's tenure, they pay the bond face value. So usually bond valuation is straightforward and may be based out of time value of money. Now you have to see the section on valuation of shares to understand what is time value of money. But in the case of bonds, things are not straightforward. There may be cases where companies may not repay its debts. So investors take this default when calculating the price of bonds and demand a higher interest rate as compensation. Governments also issue bonds for borrowing of money from investors. So that answers what are bonds and how is bond valuation done. Bond valuation, as I told you, is not straightforward and may be based out of time value of money. So you have to see the section on valuation of shares to understand what is time value of money and how it is applied in different cases. Now we'll see what are government bonds. So here we see what are bonds, what is a sovereign bond, and name some of the bonds issued by foreign countries. So what are bonds? Bonds are usually issued by the government or the corporates. It is a debt instrument whereby the company issuing the bond borrows money from the investors, where the investors receive a monthly interest payment by way of coupons or coupon payments, and towards the end of the tenor of the bond receives the bond's face value. Bonds issued by government are also in Indian rupees, which is a government bond. Now, what is a sovereign bond? So bonds issued by Government of India in foreign currencies are called sovereign bonds. Hence, bonds issued by Government of India in US dollars or Japanese yen is called as sovereign bond. Now, historically, the first bonds were issued by the English government in the year 1693 in order to fund war efforts against France. So, in order to see some of the bonds issued by foreign countries, US Treasury bonds are issued by USA, OAT or OAT is issued by France, bonds are issued by Germany, and gilts are issued by UK. So these are some of the bonds which are issued by foreign countries. Now we'll see the mechanism of bond. So for illustration purpose, we are considering how bond works. So we are considering a hypothetical situation where Indian government raised bond in the year 2009 with coupon rate 6% with 2012 maturity. So in 2009, for the investor, the price of the bond or present value is 1010.77 for rupees 1000 face value of the bond. Now the interest of the bond is 6%, which would mean every year, the investor gets rupees 60 because 6% is the interest on face value of a bond, which is 1000 rupees, and it matures in 2012. So until then the investor gets rupees 60 every year. 2010 he gets, 2011 he gets rupees 60, 2012 he gets rupees 60, which is the coupon payment, plus face value of the bond, which is 1000. So that is the mechanism of the bond. Now towards the start of the year, that is during 2009, when the investor has acquired the bond, he has to pay 1010.77 or 1010.77 rupees for a bond whose face value is only 1000. Why is it so? That is because of present value. You have to see the section on valuation of shares to understand present value. But present value mandates that for getting 1000 rupees on 2012, what is the present value of that rupees 1000 in 2009? That is the present value, and that is calculated by a formula. And according to that calculation, the amount comes to 1010.77. So the investor has to pay 1010.77 in 2009 for the bond's face value which the investor receives in 2012, which is rupees 1000. Now next is bond prices, market rate and coupon rate. So here what we see is what is market rate of a bond, what is coupon rate given to bond holders, what is present value at R% or bond price, what are some of the observations that one could deduce regarding face value of bond, market rate and coupon rate. So first, what is market rate of a bond and what is coupon rate? So it's a commonly noticed phenomenon that whenever the market rate changes, the price of the bond, by which what is meant is the price at which the bond sells, also changes. To illustrate this, let us consider a bond with face value rupees 1000 and an interest or coupon rate of 6% and is a 3-year treasury bond. So in order to calculate the treasury bond price, let us do the present value calculations, and present value at 6% for the $1000 rupees treasury bond is calculated, and it is 1000. That means to say, if the market rate of the bond is same as coupon rate or interest rate, the bond sells for its face value of rupees 1000. So here market rate of a bond is basically the price of the bond which is as per market. So it is traded in the market. So whatever is the price of the bond is actually, whatever is the market price of the bond is in fact the market rate for a bond. Now what is coupon rate? Coupon rate is basically whatever interest the investor of the bond gets on a yearly basis until the bond matures. So that is coupon rate. Now what is present value at R% or the bond price? Suppose if I am an investor and I come and see I have to buy a bond. Now what is the price at which I can buy the bond, which is the present value of the face value of the bond when the bond matures. The present value is actually the bond price, which is not market rate, but it is actually the present value at which I buy the bond. Now what are some of the observations that one could deduce regarding face value of bond, market rate and coupon rate? So here now let us consider the case where the market rate has become 10%. Market rate changes, it can fluctuate, but present value may remain constant, and for a bond with a certain tenure. So now let us consider the case where the market rate has become 10%, where the coupon rate is 6%. Remember, the market rate is calculated for present value calculations, that is to calculate at what price a bond sells or at what price an investor gets to buy the bond. And the coupon rate decides how much the investor gets in the form of interest during the duration of the bond, which I have already explained. Hence, to calculate the present value of the bond at 10%, it is calculated to be 900.55. That means when the market rate of bond is 10%, the bond with face value rupees 1000 sells for a value of 900.55. So here we have to make two important observations, which is when the market rate exceeds the coupon rate, the bond value is less than whatever is its face value, or the investor can buy the bond at a lesser price than its face value. So that is the first observation. That is when the market rate exceeds coupon rate. So if coupon rate is only 6% and market rate is 8% or 9%, the market rate exceeds. The bond value will be less whenever it's than its face value, or the investor can buy the bond at a lesser price than its face value. Similarly, when the market rate is lower than the coupon rate, the bond value is more than whatever its face value is, or the investor must buy the bond at a higher price than its face value. So these are some of the observations one could deduce regarding face value of bond or market rate and coupon rate. Next, we'll take a look at an important yield to maturity, or current yield and yield to maturity. So what is current yield and what is yield to maturity? Current yield is actually if there is a bond of face value 1000 and you pay 1136, which is the market rate, the current yield is calculated by taking the coupon rate for the first year, which is 60 rupees, because the bond is priced at 6% rate of interest. So it is 60 rupees divided by the market rate you paid for that, which is 1136, and it is found out to be 5.2%. So suppose market price of bond having face value rupees 1000 is 1136. Current yield is calculated as the coupon rate of the first year, which is 60 rupees divided by 1136, which is 5.2%. Two observations we have to make here. One is, investor who buy a bond at premium, where the bond price is above its face value, the return on these bonds will always be less than the bond's current yield. That is the first observation. Second observation is, investor who buys a bond at a discount, where the bond price is less than its face value, the return on these bonds will always be more than the bond's current yield. In other words, the current yield mismeasures the rate of return of the bond. It simply overstates the return on premium bond and understates that of discount bond. Hence, yield to maturity is required, which would take both these points into account and the change in bond value over its life. However, yield to maturity is only calculated by a trial and error method. For instance, if the present value of the bond, which is the bond price, is greater than the actual market price, the discount rate should be lower and you should try for a higher rate. Similarly, if the present value is less than the actual market price, you must reduce the interest rate. So these are some of the observations on current yield and yield to maturity. Now, lastly, what is rate of return or for a bond? So whenever one invests in bond, he or she receives coupon payments. Subsequently, bond prices, which are present value of the bond, of the face value of the bond, may change, and whenever one buys and sells the bond, one also make capital gain or loss. So to illustrate, suppose a 6% treasury bond is bought for a price of rupees 1010.77 and sold in the next year for rupees 1020. There is a capital gain which the investor makes in addition to the coupon payments which the investor receives. So the rate of return is calculated by the simple formula coupon income plus price change divided by investment. That is the rate of return. So accordingly, it is found that 6.86 is the percentage of rate of return. So this completes a session on bond and investment in bonds. Thanks.